On Thursday, March 26th, the NASDAQ 100 futures dropped 314 points in exactly 4 hours. It was a violent, deliberate move that snapped shut on traders who thought the market was heading higher. Just 24 hours earlier, the mood was entirely different. Wednesday saw the S&P 500 and the NASDAQ climb on the back of promising peace talks with Iran. Oil prices dipped, Treasury yields eased, and the board flashed green. But that rally was a trap. Institutional sellers used that wave of public optimism to quietly build massive short positions, letting everyday traders buy into a false sense of security. When Thursday opened perfectly flat, it gave no warning of the crash to come. The immediate plunge that followed was a calculated institutional grab for liquidity. The cover for this massive sell-off arrived overnight, when confidence in the Iran peace negotiations completely collapsed. The Pentagon abruptly announced the deployment of approximately 3,000 additional troops from the 82nd Airborne Division, directly contradicting the peaceful narrative that had lifted markets the day before. The physical markets reacted instantly. Brent crude oil surged, climbing past $100 per barrel by the morning bell. This flowchart shows how energy shocks ripple through the economy. Rising oil feeds inflation, which drives up the 10-year Treasury yield, reaching 4.42% that morning. A Treasury yield is the return on investment for U.S. government debt. When that yield rises, it directly pressures the valuation of the tech sector. To understand why, we look at the discount rate. The discount rate is an interest rate used to determine the present value of future cash flows. Higher yields mean a higher discount rate, making tech stocks mathematically less valuable to investors right now. At the same time, the VIX spiked to 27.45. The VIX is a real-time index representing the market's expectation for near-term volatility. When it crosses the 25 level, institutions are pricing in massive daily swings of 1.5% or more. These sudden geopolitical and macroeconomic shocks handed smart money the perfect environment. They had the volatility and the narrative cover they needed to aggressively short the market. The setup required retail buyers to stay in their positions. By opening nearly flat at 24,373.50, the market offered no gap down to spook the amateurs, keeping them confidently holding their longs. This chart maps the Thursday morning price action. In the first minutes of the New York session, price pushed up to exactly 24,421.25. It hit a hard ceiling, a precise price level where institutional sellers stepped in and aggressively rejected any further movement upward. From that ceiling, the market began a rapid downward displacement. Over the next 4 hours, price plummeted. It broke firmly below the 24,200 level. This specific zone is crucial because it held a massive cluster of retail stop-loss orders. Hitting those stops activated a liquidity pool. A liquidity pool is a dense concentration of resting orders at a specific price level. When those orders triggered, it forced a cascade of mechanical selling, driving the price down until large buyers finally absorbed the pressure at a floor of 24,107. Retail panic doesn't move with this kind of pinpoint accuracy. A 300-point displacement executed from a precise ceiling to a precise floor proves this was a coordinated institutional sweep of retail stops. Zooming out to the higher time frame, Wednesday's green day was never a real recovery. It was merely a brief counter-trend rally within a sustained bearish trend that started back in January. And the environment driving that trend is only getting more tense. The president has extended the deadline for Iran to reopen the Strait of Hormuz to April 6th, guaranteeing that headline risk will dictate market movement for the next week and a half. This is a price chart highlighting Thursday's plunge, focusing specifically on the vertical space between 24,250 and 24,350. That aggressive downward move was so fast it created a fair value gap, a pocket where the market only traded in one direction, leaving empty space behind. That unfulfilled now acts as a magnet. If price retraces back up into that zone, institutional sellers are already positioned to reject it and push the market lower. Going into the next session, the map is clear. You have a verified ceiling at 24,421.25, a confirmed floor at 24,107.00, and a fair value gap acting as a magnetic resistance zone right in the middle. Amateurs will sit down tomorrow and guess which way the wind is blowing. Professionals already have their levels marked, waiting to trade the reaction. That is the edge.